of the financial architecture, the structure of the financial system in relation to the stability and the resilience of the financial system. So this is a topic which has been repeatedly discussed in the wake of the financial crisis, the role of interconnectedness, various types of networks linking financial institutions. I'm not only talking about counterparty networks, but the various types of links we've seen throughout the talks this week and the previous workshops. And on the research side, we've seen a lot of new developments in this area, trying to understand the role of interconnectedness in financial stability. On the side of regulation, we've also seen a lot of ideas concerning how to remodel the financial architecture, how to modify the structure of the financial network as to make it more stable. So some ideas have been concerned with the introduction of central clearing, which is one way to rewire the links in the network in order to change the flows between financial institutions. And another idea that has been put forward is some kind of ring fencing or separation of sectors or activities. So this ring fencing can be thought of in terms of activities inside a given institution. It can be thought of as in terms of barriers to transactions or links in between institutions. So all of these go back to we can think of them as rewiring the network in some sense. And so the goal of this panel is to discuss what ideas are being proposed in this area, what is being done in terms of regulation, and what can the modeling and theory tell us about these things. How should they be done? Do we know really what the link is between architecture and stability and so on? So we're going to open the discussion with a presentation by John Vickers. So John Vickers is a professor of economics at Oxford, All Souls College. And as you may know, some of you may know, he led the Vickers Commission, which had as a responsibility to look at these issues and to propose some directions for structural reform of the financial system. And this report was highly influential. So he will discuss some points of this report and some other ideas he has along these lines. So I'll pass it to John.
Thanks. I hope this clip-on mic is working, but if I'm not audible at the back, please indicate and I'll switch to the hand mic. Thank you very much for the invitation and introduction. A word or two more of autobiography. My academic career has been mostly on economics of competition and regulation, but until I got involved with the Independent Commission on Banking, which is the correct name for it, I had not got involved in questions about financial regulation, and that was deliberate. I'd always thought it was much too complicated and difficult in the sense that it was a big learning curve, and you either went up that learning curve or you kept quiet, which was my approach. But then I got asked to chair this commission, and I think the main attribute that I had, which indeed George Osborne more or less indicated as such, was that I had no known view on the answer to the question. Indeed, I had no view at that point. I was completely agnostic. And then we were a commission of 5, set up in June 2010. We were given 15 months to make recommendations for financial stability, also some on the competition side, which I won't talk about unless Q&A leads on to that. And the other preliminary thing is that in our work, we, although we're best known for our structural recommendation of ring fencing, we attached at least as much, if not more importance, to questions about loss absorbency, capital, bail-in debt, and all the rest. And this session has a structural title, so I will talk about structure in these 10 minutes. But I just put down a marker that the loss absorbency issues, capital, etc., were as prominent in our thinking and our recommendations. And indeed, we saw quite a lot of complementarities between the structural issues and the loss absorbency questions. So, this is a panel, so I'm not going to be theoretical, even if I was able to be. Why did the lack of structure matter in the crisis? There's often been pointed out all sorts of banks of different shapes and sizes failed. So did famously various non-banks such as AIG. My remarks are going to be on the structural reform of banks. I think it certainly does not follow from that structure was irrelevant. I think structure mattered in all sorts of ways. One was that when you have completely unstructured universal banking, as we've had in the UK, you think of banks like RBS and Barclays, then faraway events, even if the domestic economy and domestic property prices were doing fine, faraway events, if they create a big enough balance sheet hit, or through interconnectedness in networks cause that, then they literally jeopardize high street banking. I mean, the ATMs wouldn't work. And the economic and social chaos resulting from that is so prospectively appalling that governments who can are always going to rescue certainly those core retail services and maybe much more. So we had no structural insulation at all for UK banks, and I think the same is true for a lot of European banks at the time of the crisis. That's point one. So no insulation. Secondly, in terms of government policy in the crisis, the rescue had to be all or nothing. You couldn't say, right, we'll have this policy towards RBS's trading book, this policy towards its high street banking operations, etc. Because there were no separable bits, you couldn't have different policy for different bits. So that's a point it's a kind of ex post point about resolution. But I think as well, there's an important ex ante point, the final one here where I mentioned Hyun Shin. He's got this paper on the global banking glut, which some of you will know. And he points out, I think, really quite startling fact that the role of the global European banks, UK banks, Swiss banks, Eurozone banks, in the US dollar intermediation chain in the US, with various points in the chain relating to a lot of shadow banking entities, money market mutual funds, various kinds of securitization operations. You had huge funding of that US dollar intermediation in the US coming from the European global banks, again in this wholly unstructured form of universal banking. And arguably that was part of the fuel pre-crisis as well as post-crisis. So I do think lack of structure mattered a lot, though clearly an even more important point is inadequacy of capital mattered hugely. And another loss absorbency point is the inability in practice of debt to bear loss meant that the loss absorbency was even more limited. Slither of capital, and then the debt didn't bear loss because in the legal regimes at the time it would only bear loss in a place called bankruptcy, which governments wouldn't tolerate things going to. Now, structural reform debate, I think there's been a bit more recently, but in some ways I think it was very slow to get going. You had Paul Volcker's famous proposal that in a form got into Dodd-Frank about banning proprietary trading, a word more on that later on. In the debate that resonated here in the UK, I think of the three Ks as John Kay, Mervyn King and Larry Kotlikoff. You had John Kay writing in the FT about forms of separation between retail and investment banking. Investment banking, a bit of a misnomer because investment wasn't exactly what a lot of them were doing. But you had Mervyn King making, for a central bank governor, a very striking and radical speech about a year after the crisis. And then there was Larry Kotlikoff's limited purpose banking proposal. And indeed, I remember there was a seminar at the Bank of England, Martin Helvig was at it too, about a dozen of us with the three Ks, Martin and a few others, early in 2010. And then very much to my surprise, I got asked to chair this ICB thing. We reported in September 2011, so it's more than 3 years ago. And since then we've had legislation in the UK, the 2013 Banking Reform Act. In Europe more generally, we've had the Liikanen report. Erkki Liikanen is governor of the Bank of Finland. And that's in a kind of limbo at the moment, because in January the European Commission put out a proposal of a sort of Liikanen-related thing. I think it's rather unsatisfactory. And it remains to be seen how the new commissioner in this area and the Parliament takes that forward. Now, why? This is a broad overview points. Why might some form of separation between retail and investment banking be a good idea? Well, it flows from the points I made earlier. First is the insulation point. I do think that the continuity of service provision is even more important for retail banking than for other forms of banking, in part because those other forms of banking have closer capital market substitutes than is available to the ordinary individual or small business that needs retail banking services. Put another way, I think the intensity of negative externalities of retail banking failure are in most crisis scenarios greater than for investment banking failure. Is insulation like this perfect? Of course it's not, but I would say it's very much better than nothing. I'd also point out that even with total separation, you don't get perfect insulation because there are lots of asset price linkages and all the rest in the ecosystem between retail and investment banking. But I do think some form of structural separation between retail and investment banking gives you a very valuable form of insulation. One metaphor to think about is the bulkheads compartments in the hold of a ship. Costs some money, extra steel, but for certain forms of iceberg hitting, well worth it. I think a very important point in the other direction, thinking about too big to fail, and I do think the too big to fail problem is much greater post-crisis than pre-crisis in many respects. You've got, unless there's some form of separation, the implicit subsidy that comes from deposit insurance, the lender of last resort backstop, the fact that the government is always going to rescue retail if it really has to, that all leaks through to investment banking if you do not have separation. Third point, I think resolvability, this is, unless you have the separate bits, I think resolvability of complex institutions is much, much less credible. And resolvability is crucial for the prospects of bail-in debt actually being bailed in. If you can't resolve an institution, all the talk about bail-in will come to nothing. So I think that here is a very important interconnection between the two. A lot of these points about structural reform are in the context of what I and many others think is a very inadequate approach in Basel III, much better than Basels I and II, to capital regulation. And I think a good question is, if you had super equitized banks, then I think the case for structural reform would be weaker. Might still be there, but I think it would be weaker. But we're so far away from that I think structural reform is very much part of the optimal policy mix. Question we then often get, I mean, if you propose ring fencing, you get attacked from two directions. The banks say this is very costly, we don't need to do this, etc., etc. They want unstructured universal banking, or most of them do. From the other side, you get a lot of voices saying, no, you should go for total separation, go for old-style Glass-Steagall before it got watered down, never mind repealed. Why not say any institution doing retail banking, you cannot have in any part of that group investment banking activity, not just the Volckerized prop trading, but market making, derivatives, other than hedging retail, commodities business, exposures to other kinds of financial institution, etc., etc. Well, I think there really is there are perfectly cogent arguments from that direction, but I think there's a really quite important correlation point which pushes the other way. If things are not perfectly correlated, and they're not perfectly correlated, then if you've gone for a total split, you've created a standalone, probably quite highly intercorrelated retail domestic banking sector. And for some kinds of shock, you would be in a worse place. You'd have larger expected shortfalls in that world than you would if you'd allowed some form of universal banking, structured universal banking, to continue. So here's this isn't a proper model, just a schematic. So here on the axes, imagine it's a one-shot thing. I'm a bank with a retail unit and an investment banking unit, but within a holding company. Of course, if they're both underwater, then the shortfall is the same with me integrated as if you split me into two bits. If both are doing fine, there isn't a problem. But on the northwest and southeast of that intersection point, here are cases where there's a surplus in one bank that can help ameliorate, could even mop up completely shortfalls in another context. And if you go for total separation, you are losing that. And I think it's the context I'm concerned about is where there's a retail banking failure, and if you've gone for total separation, there is no recourse to private sector resources in the rest of a banking group, which, depending on the correlation structure, might be doing fine, either in other parts of the world or in other kinds of activities. So I think it's completely non-obvious whether total separation or ring fencing is the better thing, and I think it's naive to say, well, ring fencing is just a halfway house. Why not go the whole hog? I think if you do go the whole way, there are some that you add some kinds of financial stability risks as you cure others. So this summarizes, in my mind, some of the pros and cons. If your view of the world is that retail is rock solid and investment banking is a casino, then you might favor total separation. That's not my view of the world. I think another important point is whether you think ring fence is going to work or not. And what Parliament did was to put in various measures under the heading of electrification to try to make that more durable. We could discuss that if people wanted. Now, these are opening remarks for a panel, so I'm not going to say anything about these questions other than to flag them. I've talked about ring fencing very loosely. How do you design it? Where do you, quotes, draw the line? How do you strengthen the fence, or will it be porous, or can the banks tunnel underneath it, jump over it? Very important set of issues. Should you have a Volcker proprietary trading ban in addition? Interesting question. And at the moment, you've got this UK approach, the ICB, Liikanen proposals, which I think are very similar to the UK, and then Barnier, he was commissioner when these January proposals came from the European Commission. They're a sort of Liikanen light and a kind of Volcker light as well. I think it would have been much better to go wholeheartedly for what the Liikanen group proposed. And I think that would have had a transatlantic virtue in that then you'd have the UK, the US, and the EU more generally all going for forms of structured universal banking rather than either total separation, which was the US from the 30s onwards, or unstructured universal banking, which is where most of Europe has been. This is a highbrow conference. I'm not highbrow in the subject matter here. I don't even have a toy model, but I do have a sketch of a toy model referred to in that remark there, which I laid out in some lectures at Stellenbosch a couple of months ago. And if anybody wanted those slides, I couldn't find them on the web. I don't think Stellenbosch should put them there. You're very welcome to see them, and they will elaborate a little bit on what I've been saying. To sum up, I think structural reform is a very important element of the reform package, particularly when loss absorbency reform globally is half-baked. A merit for us in the UK of structural reform ring fencing is that you could have higher than the global minimum capital requirements for retail banking in the UK without screwing up the international competitive position of investment banking out of the UK. The US has moved over the years from Glass-Steagall to structured universal banking. This is the convergence point I've mentioned. What the EU will do, I think, is a really big point to play for. I think there's a lot of unfinished business. I was pretty shocked, actually. A month ago at G20, Mark Carney, on behalf of the FSB, said that the reform job for banks is now substantially complete. I think that's just not the case, either on loss absorbency or on structural reform. So I believe these remain, in policy terms, very important questions, and intellectually very interesting too. Thanks.
So our next panelist is Laurent Clerc from France. He's out this morning, so please. Talk about structural banking reforms. Oh, you want this? Could you talk about structural banking reforms?
Sorry, I forgot the time. Okay, so what I will do is probably try to complete what has just been presented. So to start with, so John commented on the G20 agenda. So it's fair to say that the issue of structural reform is probably part of this global agenda. You mentioned CCP trading, etc., OTC derivative, shadow banking. But when you look at the proposal and the G20 agenda, it's fair to you have to remark that structural reform per se are not part of this agenda. That is, that there are other issues like increasing total loss absorption capacity, but not the structural reform per se. So one reason is maybe that this will have an impact directly on the business model, and usually regulators refrain to directly design the structure of banks. So there are three main objectives. The first is to protect retail banking activities from the risk stemming from the financial market activities. And so financial market activities has been portrayed as risky or speculative activities, and this is also part of the political agenda after the crisis. The second aspect is to limit, and that was the point you emphasized, the subsidization of financial market activities within banking group by the implicit or explicit public support that is usually provided through deposit insurance, so to the retail part of the banks. And the last aspect is this idea of reducing too big to fail, and in particular the impact of bank failures on the taxpayers. So here I don't know whether you see it. So these are a brief summary of the different reforms implemented in Europe. So there is the approach in the UK, France, Germany, Liikanen, which you alluded to, and Barnier, which was the latest proposal. So what they do share in common is that their approach is to ring-fence activities, that is, to separate or protect retail banks from investment banks. So there's no separation like in the US, although in France there is some form of some activities are forbidden, like HFT trading or proprietary trading on commodities. And in Barnier, the latest proposal, there is also a ban on proprietary trading. In the UK, the ring-fence part is the retail bank, so you protect the retail bank from the rest of the world. In continental Europe, it's the reverse. The ring-fence part is the trading activities. So you protect the rest of the world from the trading activities. So it's a symmetric approach, I would say. Then all these reform list the activities which are allowed in the ring-fence part, and the main line of divide is the location of market-making activities. So in some cases, the market-making activities are allowed in the retail branch, whereas in others they are strictly forbidden. So they are allowed, for instance, in France and Germany, but in the two proposals by Barnier and Liikanen, because it's difficult to disentangle proprietary trading from market making, they are only in the trading branch. What is interesting in these approaches is all of them are based on thresholds. So that is, if you reach a certain threshold, then you will have to ring-fence part of the activities. So here it's interesting because the idea is that you are directly attacking the size of the institution. So when we talk about systemic risk, interconnectedness, etc., it's not necessarily the size which matters. It's the extent to which you are interconnected to other institutions. But here the focus everywhere is on the size. And then there are regulatory requirements which are set at the solo basis. So there are several issues for discussion. So the first is obviously the extent to which you will preserve some of the benefits of the universal banking. So in the different approaches, it's not clear whether universal banking model is preserved. So you can have it still in a model where you have a holding company with two branches. So in a way it is a universal bank, but then you do not have necessarily the capacity, or you do not have necessarily the synergies or economies of scale or scope that you find in the normal universal banking model. And that is an important aspect because obviously when you look at the outcome of the crisis, there is no there is no business model that has proven more resilient than another. So there have been retail banks which have failed, investment banks which have failed, universal banks which have failed. So it's very difficult to say which is the best form of organization. The second challenge is to draw an effective and, in fact, welfare improving line between what you call speculative and economically needed banking activities. And here the issue is really what you do with market making. So in France we consider, for instance, that market making is an important part of banking activities, and therefore it should be also maintained in the retail part of the bank, whereas in other countries it's less clear. And I think the difficulty here stems from the fact that you cannot necessarily disentangle what is proprietary trading from market making. And so there are some cases where it's particularly difficult to disentangle. It's when you have like OTC trading, where you have markets which are not that liquid with a low number of transactions. So effectively the bank is not operating on a continuous basis, but it's difficult to say whether it's proprietary or retail or market making activities. And it is very hard to draw the line. And if I take the example, for instance, in France of the transaction task, the financial transaction task, there was an exemption for market making activities. So when we started to implement this tax in France, we discovered that there were many banks which were doing actually market making. So you can also play with that. So it's a challenge to implement. And then the third aspect is there are two pitfalls. The first is to generate even bigger systemic banks. So the idea is that when you are separating activities, there is a question on whether these two different activities will be viable. And this is certainly the case for the trading part, where you would have increasing financing costs, and it's not clear whether these activities will remain viable. So one way to make them viable is to merge and to get bigger, and therefore this is the contrary to what you want to achieve. And the other risk is obviously to moving part of these activities and the risk in the shadows. And the last question, but you alluded to it also, is the articulation with resolution regime. So obviously when you separate or you ring fence activities, you are dealing with complexity, and in a way when you want to implement resolution, it's easier in a context where you have different activities which are separated with their own legal architecture and requirements. But the fact is that, and I think it's the reason why you were probably disappointed by the remark by Mark Carney. The fact is that when you think, I agree with you that we are not there yet, but when you think that in fact you have made tremendous progress in terms of resolution and total, and improve your ability to raise total loss absorption capacity for banks, that is commensurate to having higher capital in the banking system, probably the motivation for really implementing structural reform is not there anymore. So, and that's it. Thanks.
Thank you.
So thanks very much. Laurent and John are both focused on the structure of banks, and I'm going to take a slightly different but hopefully complementary tack and look at more around issues and policy issues around the structure of the network and the connections between institutions and how you might regulate or approach regulation of the structure of the network. I'm going to divide my comments into three sections. I'll actually start with a few comments around the modelling approaches to thinking about modelling financial networks and some of the challenges there, partly because I know that might be of interest to many people in the audience, but also because that I think sets the framing for thinking about some of the policy issues. I'll then move on to some of the issues around risk assessment and data, which is going to be important to any assessment of the risks on financial networks. and then conclude with some discussion of some of the key issues around policy design. So to start with issues on the modelling approach and challenges and some of the directions, I think there's a tremendous amount of work that has been done on financial networks, and I've got a few observations there in which the direction I think that ought to head to make it more useful for kind of policymakers when thinking about both risk assessment and policy. I think the first of those is that a lot of the work that's been done on networks that started out with relatively simple network structures, whether that involved like a circle of banks, 4 banks, or a random graph that was Poisson in nature. Increasingly, we're moving to worlds with more realistic network structures, but I think that's particularly important. And the reason I say that is because if you look at the data, you find that real-world financial networks have very fat tails, by which I mean you have very important institutions, so the systemically important institutions that John and Laurent have been speaking about, but also the distribution of connections between those financial institutions exhibits strong fat tails. And what we care about in terms of financial stability is primarily around the core institutions and the risks that they pose to the rest of the system and the spillovers and the systemic externalities. And so shocks to those institutions are the ones that matter. And you can only really analyse that in a network which permits that sort of heterogeneity. My second observation is that, again, much of the literature started by looking at, I think, domino effects. I think Martin Hellwood gave a talk this morning where he probably talked about different contagion channels. And that looks at sort of straight counterparty risk, credit risk, default contagion, which matters clearly at the point of default. And that's definitely a starting point. But I think it's important to broaden out to consider a range of the other sorts of channels that he and others have spoken about. So liquidity risk, the hoarding of liquidity in interbank markets, fire sale effects, pure confidence type effects. And there are 2 reasons I say that. Firstly, the experience of the crisis is that a lot of those effects kicked in long before the point of default, and contributed to a lot of the distress in financial markets. And the second is the link to policy. So a lot of the issues around resolution, which has already come up, and structural reform, to some extent that's to do with how you deal with institutions once they have failed. But a lot of the externalities that are created by financial institutions in terms of the real economy spillovers, in terms of distress for other financial institutions, occur through the actions that banks, financial institutions take while trying to save themselves from going into resolution or save themselves from going into bankruptcy or default. And actions like hoarding liquidity or selling assets in a fire sale or cutting lending to the real economy are the things that to some extent drive a lot of the systemic risk and are very important for thinking about policy responses. So when thinking about networks, again, it's important to think about some of the dynamics that occur before the point of default. And the third aspect, which relates to some of the discussions around macroprudential policy that I mentioned in my own talk earlier, but also there was a panel on this yesterday, is that you can also think of time-varying risk on financial networks. So most network models are static. But if you look, for example, at, just to take one statistic, the growth of debt in the UK between 2003 and 2007, if I were to break down that growth in debt into different components, so household, corporate, government, and so on, if you were to read the media, you would think there was a big explosion in household debt and there was a big explosion in government debt and there was a lot of borrowing going on. If you look at that structure of debt, there was growth in household debt, but 2/3 of the growth in debt in the UK between 2003 and 2007 is accounted for by financial corporate debt. Broadly speaking, intra-financial system lending and borrowing and other financial type instruments. So the vast bulk of the growth in debt in the UK was intra-financial system activity. It is also true in the US. You see this from the work of Tobias Adrian and Hyun Shin in terms of looking at repo markets, for example. What that says is that network risk is not a static concept. It varies over time, and it's important to think when modelling it about some of the time-varying dimensions of network risk and associated policies to deal with that. How does that translate into some of the thinking on risk assessment and data? I think where we should be looking at in terms of understanding risk on the network, in a sense, when you're trying to look at things in what could go wrong, what you want to be able to understand is perhaps identifying that next AIG, the SIFI that's going to cause distress. So one of the key things here, I think, is having a lot better data on financial networks. Laurent's already mentioned shadow banks, but one of the problems of non-bank financial institutions, in a sense, is that the data on those are very poor. The connections, the understanding of the connections between non-bank financial institutions and the core financial institution is poor. Another example is, what are the true exposures? How are derivatives treated? What is the approach to netting? What is the maturity structure of linkages between financial institutions? So short-term liabilities between financial institutions are particularly prone to liquidity risk compared to long-term maturity. Data on that is very poor. So if we try to have a true sort of real-time monitoring of the financial network in the sort of way that perhaps you have real-time monitoring of epidemics, of disease epidemics, I think we need a lot better data. The other thing I'd say is that in terms of trying to do sort of risk assessment, I think we want to try and develop better indicators that are simple and intuitive for understanding network risk, and then try to complement that with sort of stress tests of network risk in financial systems. Coming on to the third thing, so what does this mean for regulation and the structure of the network? Now, some of this network risk clearly does relate to resolution, ring fencing, and so on. I won't go into that because I think that's been already adequately covered, but clearly that is going to help deal with network risk. As I've already alluded to some extent though, some of the pre-failure concerns are probably, relatively speaking, less addressed by that part of the reform agenda. So that points to other sorts of policies. And I think there are a couple of developments and a couple of areas for development in this space. For me, one of the core parts of the overall regulatory reform package that has come in are sort of capital surcharges for systemically important institutions. So if you look at the pre-crisis data, typically large institutions typically had lower capital requirements and higher leverage ratios, were more leveraged than the smaller institutions, because they were, regulators felt they were diversified and therefore in some sense safer. But a network approach says those institutions are really core to systemic risk. So actually you want them to be even more robust to shocks. So having higher capital requirements for systemically important institutions makes a lot of sense. It might also have an incentive effect on encouraging them to become less connected. But I think it's important that we don't stop there. As I mentioned in the last talk, those higher capital requirements should carry across to the leverage ratio. So we need to have higher leverage requirements also for systemically important institutions. That's the direction in which the FPC has gone, but it's also the direction in which the US authorities have gone, in which the Dutch and Swedes and Swiss and so on are also thinking about going. And I think it's important that we have some international progress on trying to develop leverage surcharges for systemically important institutions. It could also be a case that might apply to some of the liquidity standards as well. Then going on to the time varying dimension, I think it's also important to think about what other policies we might deal with the time varying elements of network risk. And here I think this speaks to the overlap with the sort of standard macroprudential policies around countercyclical capital requirements and so on. But in particular, I think there are 3 or 4 policies that might speak specifically to the network risk dimension. So firstly, it might be important to think about sectoral capital requirements or raising the risk weight against intra-financial system exposures. So there might be circumstances, if you're worried about a build-up of network risk, you might raise the risk weight on those type of exposures. So the European legislation on macroprudential policy specifically allows for that type of policy to be deployed, which is very helpful. In addition, you might want to think of time-varying liquidity requirements to deal with some of the liquidity risks you see on networks. And in the way in which loan-to-value or loan-to-income restrictions might help in macroprudential dimensions in the mortgage market, you might want to think of margins, which are broadly speaking the analogue of an LTV in the financial market, as being deployed as a macroprudential tool. So the FSB has agreed to, as a set of proposals around minimum margining practices in a range of financial markets, but there might be a case in future for developing time-varying margining standards, so that as risks build up in the system, the margin requirements become more stringent, so that there is more insurance built in. An additional area, so that's kind of focuses on some of the sort of, I guess, what are balance sheet, prudential type standards. But you could also try and think about the network itself, and I think there are important dimensions around trying to promote netting of transactions where possible, and central clearing, which can also help to reduce the complexity of the overall network. Now, the central counterparties also need to be kind of very resilient in those circumstances, but those sorts of policies might help to reduce some of the iterated linkages and dimensions of complexity which create a lot of risks in the network. So those are some sort of suggestions for specific policies, some of which are happening, some of which are proposed or ideas. But I think also underlying all of this, I think there's an important question about why these exposures form in the financial network. So there are some types of linkage which are probably, there are different types of linkage, and trying to understand which are most welfare enhancing and which create the most risks is going to be a particularly important, I think, area for future work, because I think that's going to be very important in trying to understand where we want institutions to be connected for very good reasons, because it helps with risk sharing or enhancing welfare, and which particular types of linkages and on the financial network might be particularly problematic for systemic risk. But thanks very much.
Thank you. So I think John wants to make an additional remark, and then we pass.
So if I may, because this is my only go on the stage this session. So if I can make a couple of comments on what Sujit just said, and then a couple on Laurent's comments. One point that came back to me was that you might be wondering, was there any influence at all about people who work on the mathematics of networks upon our thinking in the Independent Commission on Banking? And the answer to that, you could read our report and think there was no influence at all, I think. In fact, though, there was a very significant influence through Bob May, who you know well. So we had an away day for our fantastic team of about a dozen in Oxford, and I'd known Bob a little bit. So I said, would you come and talk to us over sandwiches at lunchtime? So he said, sure. And we read some of writings anyway. So all these points that you've just been articulating about the ecological read across the super spreaders and the rationale for doing more in relation to the big players, which is exactly the approach we took on loss absorbency and the capital requirements of the big banks. That was in fact, I think we were on that track anyway, but were very, very encouraged, and I think it gave a lot of cogency to that line of thinking. So that was a real influence on us. Second point, at the end of what you were saying about time-varying risk weights and this, that, and the other, let's not forget the lesson of your talk before the tea break about keeping things simple. And in a way, structural reform can be put in that context. It's a bit like saying you've got an infinite risk weight for doing market making out of the retail bank. And you might say, well, why infinite? Why not 2.8? Infinite seems a bit. But I think there is a simplicity point that you just say, no, you can't do that out of that bit of the bank. And it's just easier to monitor. You don't have the gaming issue, et cetera, et cetera. So those are my comments on Sujit. On Laurent, I think just for an important point to clarify is how very different the Volcker type proposal as being interpreted in parts of Europe is from ring fencing. It's not just what do you do with market making. The Barnier Volcker thing is such a narrow definition of proprietary trading that I can tell you to any number of decimal places you want how much of it the British banks do. 0.0 recurring. They do none at all, and they're more or less on oath to that effect, because the Parliamentary Commission that looked at these questions wondered whether to add Volcker to what we were doing. And none of it by that definition happens in the UK. Mm-hmm. The French thing, I've heard people say it might get 1-2% of the balance sheets of the big French banks. The same with that definition applied to what the big German banks like Deutsche Bank are doing. Mm-hmm. So it affects hardly anything. It's all, a cynic might think that proposal is the result of maximizing the ratio of apparently doing something to really doing something. So I think that is not, I'm not against it, but I just don't think I think it has the danger of being a distraction, but it doesn't do very much substantively. What the ring fencing in the UK does, taking the balance sheet of the UK banks, say 2008, 9, 10, ring fencing keeps more than 60% of their balance sheet out of what the retail part is doing. Because it's not just the prop trading, it's not just all the other market making, it's all the underwriting activities where I do differ with Lykken, and I think that should not be allowed in the retail bank. It's writing very big derivatives for periods of time in which big risks can hit. I think that should not be allowed in the retail bank. It's what you were saying about this enormous growth of exposures to other financial institutions. In the UK context, it's all, what was going on in the US, all the losses in Australia, like HBOS had big losses. That wouldn't be allowed in the same entity as is doing British/European retail banking. So it is a much, much more far-reaching proposal. And on this job is substantially complete thing, I think that was a very, very unfortunate thing to say, because although that FSB proposal for the G20 is a good slab of bail-inable debt, it's only bail-inable. Will it be bailed in? What will the regulator actually do it when push comes to shove? And I think that's intimately related to the question of what structure will these entities have. And if they're not in decent shape structurally, I think the prospect of that loss being absorbed is not as great. Another enormous shame is that the FSB called it total loss absorbing capacity. 6% of the balance sheet is total loss absorbing capacity. You think, what about the other 94%? It's just an extraordinary use of language. So although I admire the quantum of bail-inable debt that came out of that meeting, I think in other ways it may not have been a setback, but I think it makes me pessimistic about the momentum going forward, and I think that's a terrible shame.
Thank you. So let's open to the floor. Anybody with questions? Yeah.
I have several reactions. I like the fact that people are moving back towards Glass-Steagall, because I actually like Glass-Steagall a lot. I think that having lots of different activities underneath the umbrella of the deposit insurance is bad, and in private markets, the people who bear the downside, the debt holders, have restrictive covenants that help to protect them against the firms doing lots of things, and we need the regulation and we need restrictions on lines of business and things to help that. I worry about this ring walling. It wasn't in the Fantastics. They said the walls or fences are meant to fall. I think it reminds me a lot of things we've seen in the U.S. over years, the Chinese walls, and there's a lot of stuff about having the bank holding companies, and okay, you're not in the same unit in the holding company, and there have been some not so long ago scandals about entities that run mutual funds and then at the same time give some clients inappropriate access to the mutual funds, and both in terms of information and in terms of trading opportunities. So I think for simplicity, I think having separate organizations rather than trying to manage it within an organization is much cleaner. The other thing is I think whatever opportunities there are for risk sharing and for liquidity sharing between the two sectors can be managed through markets, and it's a lot more transparent that way. So I'm less skeptical. I think that there are ways of managing the types of gains that you're talking about, which are going to, whatever gain. I mean, those gains are a little nebulous anyhow. But to the extent that there are needs for risk sharing, allow the investment banks to invest in equity in the commercial banks when they need funds and things like that. The other thing I think I'd like to talk about is an accounting issue, and I learned about this from Pierre Leong, who's at Carnegie, and he and I actually have there was a paper I wrote, which was kind of a practitioner-oriented paper on risk management quite a while ago. I wrote it initially with Bill Marshall, and we wrote an updated version, and mostly we needed to update the accounting, and he helped us to update the risk accounting. He gave a talk which was really interesting that talked about the notion of entity in accounting. If you have something and you own it in the firm, accounting isn't so bad. And if you sell it off completely, accounting isn't so bad. But accounting isn't really structured very well to handle something where you sell something off, but you retain some of the credit liability, something. And a lot of times those things end up off balance sheet. And I wonder if there's something that can be done in the regulatory sphere, working with the accountants, to improve the notion of entity and to try to get around some of the problems with off-balance sheet things. If you have a special purpose vehicle and it looks like it's a completely different entity in terms of the accounting, but in fact you retain some liability for things that it does, then we need some kind of revision to the accounting rules to represent that accurately.
Yes, that was a comment more than a question, but do you want to react to that?
I mean, I find myself at two different kinds of conferences. There are lots of bankers, and they, I mean, maybe there's some here, which would be great, but where I have to defend ring fencing versus the alternative of totally unstructured universal banking. And indeed, there are conferences with European policymakers where I have to try and do the same thing. I'm, in a sense, more worried about your line of criticism, which is that total separation is the better policy measure. Now, I actually I think that's not the case, but I think that's more likely to be the case than that leaving everything unstructured is the right way to go. And I do think there is I think this diversification benefit, which is relevant to the externalities and welfare. It's not just a private benefit. I think there is a real diversification benefit that you lose if you go for total separation. Now, it might still be the right way to go, and part of your point was the fence is going to collapse or whatever. Anyway, now, I don't believe that will happen, but it's a possibility, and it's one of those things where time will tell. Of course, don't forget that Glass-Steagall itself got eroded. I mean, total separation wasn't total separation either, long before its repeal.
Yeah,
it's a de facto, yeah.
There's no accounting for all the things. Basically, the regulator said, let's not use up the deposit insurance fund. We'll give exemptions to Glass-Steagall instead. And over time,
That's
by
right.
the time it was repealed, it was gone.
Kind of long gone, yeah. So I agree with that. So, I mean, I continue to think that ring fencing is the right way to go, and I think it's having significant effects, for example, in the credit ratings and spreads. I think the funding costs for, I think there's, I don't think the taxpayer is totally off the hook for the investment banking risks, but I think is much further from the hook. And the place you want to get to is exactly in line with your point about covenants. I mean, if it's an engineering firm, probably has leverage of, I don't know, 2 rather than 30, 40, and the bondholders will be very vigilant. Whereas if the banks have got, non-equity finance is 95, 6, 7% of what they're doing, but we've been in a period where the providers of debt finance have either been totally unable to monitor, as in the ordinary depositor, or have no incentive to do so, because they would be either they'd be bailed out or they thought there was no risk of taking loss anyway. Either way, what the heck?
Question from Stefano?
I have a question. I think that this discussion is really very fruitful, and based on the insight we got from all these studies on systemic risk in the recent years, in particular those encompassing networks, I think that this element of the separation between investment and commercial banks is, I would say, probably a necessary condition. However, and in line with what Sujit was saying before, now let's imagine all the investment banks are separated each from their commercial bank counterparty, but they are interconnected in a network of other type of contracts. Then what have we really achieved? That we still have a systemic risk issue on the investment bank side, which would then eventually obviously percolate on the other side. So even if we have separated each institution, there will be infinite ways in which this is still a systemic risk issue. So aside from this observation, then what I would like to offer as a question to the panelists. Would you think that in addition to this separation, probably maybe 3 dimensions, what do you think would be important? One is leverage, obviously. The second is interdependence in the sense of network externalities, and then complexity also both of the instruments and the structure. Would you see that this would be like a sufficient but simple enough set of dimensions around which we should think about regulation in order to mitigate systemic risk?
1 minute each.
Leverage, certainly. Now, regarding the extent to which structural reform are properly addressing the issue of interconnectedness between institutions, I do not think it is the case, especially the point you made on the trading part. And I think that the credibility of this separation is there also, because it's not clear to me whether you guarantee that in that context public authorities will not intervene in case of problems. So I think that you have not avoided the risk that you still have risky institution in that context. And the other point is that it's not always clear to me also whether the risk is fully located in the trading part, but there are also risks which are located in the retail part. So if I look at a lot of crises which has been generated by housing booms, this is traditional banking. This is not really trading or market making activities. So I think that the only consideration I think is that it makes the system or the organization of the structure less complex, because you have separated entities, and so that may facilitate resolution. But for the extent to which that it limits the risk of contagion or interconnections, I'm not sure.
Yeah, I mean, I broadly agree with the channels you've outlined, but as Laurent said, I think there are a couple of others. I definitely think something around time varying risks, credit booms that could be real economy credit booms, and speak to macroprudential policies. I think resolution is important as well. But looking at leverage and liquidity as in terms of the prudential metrics, structural reform as we're talking about, thinking about interconnectedness and complexity, I think all got to be really important parts of the architecture as well.
So can I just clean up 2 points on that? First, of course, structural reform does not get rid of interconnections, because there are all sorts through asset prices and the rest. And that's equally true if you go for total separation. But I do think structural reform gains you quite a lot, both ex ante and ex post. I think it, not perfectly, but it does get the taxpayer much more remote from the hook, from being on the hook for all sorts of investment, wholesale, market making, other side of the world kind of banking risk. And that affects the ex ante funding costs of those activities. If they don't have such a subsidy coming through from the deposit guarantee and all the rest of it, then there is more discipline on the taking of those risks in the first place. And this, if you stop that kind of funding, it's the Hyun Shin point. I mean, this fueling this global banking glut on the back of European retail deposit insurance. I think that's those are better ex ante incentives. Then ex post, you have this. I mean, I think very simple point, but very important one. If you've had a separation, then governments can apply different policies to Part A as Part B of the retail investment banking part, or the European part versus the Australian part, or whatever it might be. And if you don't, it's effectively a constraint that the government in the next crisis has to treat all those bits identically. Now that's a constraint that sounds pretty painful one to me. It's not one you would choose to have. It's not like a Tom Schelling, yes, it's a nice constraint because it commits me to do something I want the courage to do. This sounds like a bad kind of constraint. So that ex post benefit, which is the resolvability point, I think is another big plus from these lines of structural reforms, provided they're radical and not just this tiddly-volker bit round the edge.
Yeah. If I may, I'd like to be the advocate of universal banking for a minute. You stress the point that it's very hard to draw the line between speculative and non-speculative activities. Basically, that hedging a trading book is speculative and retail banking is not speculative. Well, if you look at retail banking, you need to hedge interest rate risk of retail products. You need to hedge gap risk. And in the process, you use all kinds of derivative swaps and other derivatives. And we know what happened to the savings and loans in the US, which was not very similar to retail banking in some ways. So with universal banking, you have economies of scope in the sense that you have one treasury, one LM group in the bank, with probably much better expertise in hedging risk than you will have in a pure retail bank.
We asked the banks to come forward with evidence of economies of scope. Very little came forward. The structured universal banking retains many of the benefits that you're talking about. You can still have one-stop shopping for large corporate customers and all the rest. But my main comment on your intervention is that, for me, the key distinction is not speculative and non-speculative, which I think is, I think of Queen Elizabeth I saying we shouldn't open windows into men's souls. Very hard to know when a transaction is that or not. For me, it's a much more far-reaching distinction as between retail and investment/wholesale banking. And what our approach to drawing the line, which is exactly what you see in the legislation now in the UK, was to say there are certain core activities, the continuous provision of which is a kind of imperative. Those, for any bank, a sizable bank, have to be done in the ring-fenced entity, which has has its own and elevated capital requirements, has its own board of directors, lots of restrictions on what it can do in relation to rest of bank and the rest of it. Then there's an enormous range of activities, all kinds of market making, speculative or not. We don't need to get into that question. That's not allowed in the ring-fenced entity. Neither is the commodity trading, the exposures to other kinds of financial institution, things in Australia, America, and all of that. That cannot happen in that. Then there's a big middle range of what you might think of commercial banking, deposits from large corporates, loans to large corporates, mortgage lending, and so on. That can be up to the banks and their customers. That can be out of the ring-fence bit of the bank or the other bit. That's fine. So that we didn't want to regulate more than we needed to achieve the goals, and that's the nature of our proposal. But I'm sympathetic to you in that I think there are some benefits of universal banking which you lose if you go for total separation. And I'm sympathetic that it's very difficult to distinguish between speculative and non-speculative, and our approach didn't, whereas some sort of Euro-Volcker things try to.
Other questions? I have two questions, actually, one more practical and another one more philosophical. So, during the crisis, there were these special purpose vehicles that supposedly also were balance sheet remote. And then when the crisis hit, they weren't, nevertheless. So the ring fencing, as it's being implemented now, when the next crisis hits, will it work in practice? Then the second question is we're writing more rules and more regulations, and the pages just add, is it possible to keep all these rules consistent? And if not, could an alternative paradigm or an alternative path to reform be to subtract from the regulatory body rather than to add? To the panel, whoever wants to respond.
Probably on the consistency, I think there is an effort to go towards consistency, and I think that was this idea of coordination made by the FSB, which sort of has developed and proposed a regulatory agenda which is, so to speak, consistent. Now, effectively, in practice, when you implement this reform or you develop this reform, you still have these silo effects where part of it is derived in a way which is not necessarily consistent. And I think what the table shows and the discussion shows also is that you have also jurisdictions which are implementing their own agenda, which is not necessarily consistent with the rest of the legislation. So you might be in advance or late, or you can design different kind of structural reform. So in the table there are like 5 different approaches, but none of them is exactly the same. So, and here we are in Europe, there should be some consistency, and we see that so far it's not the case. So it's very difficult to keep things fully consistent, I guess. And with respect to subtracting, I think it's it will be, well, probably in that's the scope of the task force of the Basel Committee, which is to simplify the framework. So in a way, I think regulators have come to the point that, well, probably even them don't understand the full architecture or the incentives that are provided to the financial industry.
Can you comment on that?
2 quick comments. On the simplicity point about regulation, again, I think that structural measures net simplify things, rather than complicate things. They make a lot of tasks, including supervision, simpler. And the number of pages of the legislation that ring fencing and related measures occupies is not great at all. That Banking Reform Act ended up quite thick because it became a Christmas tree on which lots of other things got like payment system regulation, a good thing, but it's all put in the legislation. Standards and conduct and all these things, but the ring fencing bit and the secondary legislation and the PRA, Bank of England publications on how that's going to be implemented, I don't think they're horrendously complicated, and I think that avoids a lot of complexity. On consistency, EU adoption of Liikanen would make would make a much more consistent more consistency within Europe and between Europe and the US than what Barnier proposed. So I'm all for consistency.
Other questions? Natalia?
So my question is, do we really need to impose this physical separation of market-based activities and traditional banking? Because probably the way to go would be just to increase capital requirements, and this will provide banks with natural incentives to limit their exposure to this market-based activities.
I mean, that's the point I touched on. If you had everything super equitized, you know, leverage ratio no more than 2 or something allowed, then arguably the case for structural reforms on top would fall away. But we're many, many orders of magnitude away from that, and it's debatable whether or not that such high capital requirements would be socially optimal or not. I mean, Martin and At would say there's no social cost at all, and if that's right, then that would be the way to go. But there are some counter arguments. Now we're so far away from that I think structural reform is an incredibly important complement, and actually, and I've said this before, I think it enhances loss absorbency by increasing the chance that in the next crisis, not only equity would bear loss, that some of this bail-inable debt or whatever would be converted into equity or would directly take loss. I think that is more likely with structural reform than without structural reform. So even for somebody who thinks it's all about loss absorbency, I think they too should support structural reform given where we're starting from.
Chris?
Would Northern Rock have qualified as a ring-fence bank?
Well, I think it would, and another case in point is the co-op, And the SNLs were mentioned too. I never liked this utility casino characterization of retail and investment banking, because I think a lot of investment banking is fine and economically very positive, and I think these pejorative terms should be used with care. But the idea of retail banking as some safe utility is absolute nonsense. I mean, Northern Rock, I think what they were doing, I don't think they were doing any investment banking, so this separation wouldn't have.
But they were borrowing from the money markets, not from the depositors.
Absolutely right. So it was a story about their woeful capital inadequacy and extraordinary reliance on very short-term wholesale funding in a context where, the maturity of a lot of their lending was about 100 times the maturity of a lot of their borrowing. It was very fast rollover on one side of the balance sheet, and 25-year loans, some of them at 125% LTVs on the other side of the balance sheet. So, when that seizes up,
so kind of round the back of the question was, if you have a ring-fenced bank, is it actually allowed to go out and participate in the financial markets, or is it simply going to be taking depositors' money and lending out to SMEs and mortgages?
No, it can do more than just that. But there are both on the exposure side and, admittedly to a lesser extent, on the liability side, there are certainly limits on what it could do. But I'm definitely not saying ring fencing would have prevented Northern Rock. And this came up actually we were quizzed by various parliamentary committees, and Martin Taylor said, and neither would heart surgery cure cancer. It's just that you need other instruments.
I think the Northern Rock case just highlights the importance of having prudential liquidity and leverage standards that they didn't exist before the crisis, and those things are now introduced under Basel III and would, in principle, ought to capture a sort of business model like Northern Rock, and so there are different parts of the response, regulatory response.
Other remarks? So just building on Chris's remark, so what is exactly the problem that ring fencing or this type of structural reform is supposed to solve? Because if you take the symmetric example in the US of banks that failed spectacularly, they were, there was Bear Stearns and Lehman, they were investment banks, they were pure investment banks, there was no retail component either. So here are two examples of ring-fenced banks which failed, and the failure was, these are three very important examples. So it doesn't seem that the fact that they were, engaged in only one type of activity and not the other helped them in any way. It was not really. And here it goes back to your own remark on diversification. So actually, the large US, the universal banks, which had a strong deposit base, they also had some investment banking activities, but they managed to go through the crisis because of this diversification effect you were referring to, because it gave them the capital base to actually survive their huge trading losses. So this kind of would go in favor of the diversification argument, and it's not clear to me why you would think that the ring fencing is the important thing to do here.
Well, I think gives you, I'm repeating myself, but I think there are three general advantages and a positive side effect as well. For me, the shocking thing about, I'm all in favor of this macroprudential, this suite of policies on macroprudential regulation. But for me, the really shocking thing about the crisis was not so much that there was a housing bubble in the US and elsewhere that burst. It was the fact that the entire financial system nearly fell over because of that. And looking back, it almost happened in slow motion. You had the August 2007 seizing up of the money markets. You had Northern Rock in September that year. Even after that, RBS bought a huge chunk of, British High Street Bank, huge chunk of ABN AMRO. That's after Northern Rock and all that. Then you had Bear Stearns in March, and equity markets were still, everyone was looking quite happy. And then it was only in, particularly in September 2008, that it was just edge of the cliff time. And you had this retail banking, which solvent governments couldn't let go, with no fire breaks, no insulation at all between the risks emanating from that, derivatives written on all that, and so on, and what was going on in the high street. And again, you had, to an earlier point, you had these things off balance sheet, jump back on balance sheet, and the very same balance sheet as the retail banking was being done from. And now, ring fencing wouldn't have saved us from the crisis, but I think it would have given valuable degrees of insulation and fire break. None of it perfect, but that would have been one big advantage. Ex ante, you wouldn't have had the insured deposit-backed funding fueling a lot of these investments in the first place. I think that's a very big point. There was one, our hearings were confidential, but it was one great moment when someone who I mustn't name, from a bank I mustn't name, said that his bank had never used a penny of retail deposits to fund any investment banking. So he said, then ring fencing, you're fine with that then? Oh! And then back to the resolution point. The policy options, when the crisis hit, there weren't any. It was all or nothing rescues. And ring fencing would put you in a much better place. Oh, and the side effect was ring fencing means we can have, because I do think capital baseline is way too low. It enables us to have much higher than Basel baseline for the UK retail banks. And I think there's this GSIB agenda, which I think is good for the regions that Sujit gave. But the number of countries where the same approach has been taken to the DSIBs, which is perfectly logical, almost a corollary, is very, very limited. It's the UK, Switzerland, and then the US has been doing more in the last few years. But that has not been applied around the world, or indeed around Europe.
Thank you. If there are no other questions or comments, let's close the panel session. Thanks.